Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, and other industry leaders to help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and our Dakota Live content, please visit our website at dakota.com. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Welcome back to the Dakota Live podcast. I am very happy to introduce our guest, Chris Vella. Chris is the Managing Director and Chief Investment Officer for BNY Advisors. In this role, Chris Vella leads BNY Advisors, an investment team focused on delivering solutions for intermediary and institutional clients, with responsibility for more than $175 billion in client assets on a global basis. The team of roughly 80 investment professionals spans global macro and asset allocation, manager research, and private market investments. Chris's career in manager research and multi-asset investing spans more than 3 decades. He began at SCI Investments, where he spent close to 6 years focused on international and emerging markets equity manager research before becoming one of the founding members of Goldman Sachs' external manager business, where he led the international and emerging markets equity team. A manager research specialist by background, Chris has spent his career evaluating, selecting, and overseeing external managers across global equities, fixed income, real assets, and alternatives. That allocator's perspective, focused on asset allocation, manager selection, and portfolio construction, rather than individual security picking, has defined his approach throughout his career. He then spent nearly 2 decades at Northern Trust, where he served as Global Director of Manager Research and ultimately as Chief Investment Officer of the firm's $75 billion multi-manager investments business, overseeing investment strategy, manager selection, and portfolio construction for institutions, foundations, endowments, and high net worth families. Chris joined BNY in 2023 as Chief Investment Officer for Investor Solutions and was named Managing Director and Chief Investment Officer of BNY Advisors in January 2024. His work sits at the intersection of manager research, asset allocation, and portfolio construction, designing and managing the model portfolios and custom solutions that BNY delivers to advisors, RIAs, wirehouses, family offices, and institutional clients. Chris earned a BS in Finance magna cum laude with a minor in Applied Mathematics from Lehigh University, where he was elected to the Phi Beta Kappa Honor Society. He is a CFA charter holder and a member of the New York Society of Security Analysts. Chris Vella, thank you for being here. Welcome to the studios in Philadelphia.
Thank you for having me. It's great to be here. Very excited.
I'm very excited too. I feel like I said to you earlier, we did it.
Exactly. It's a long time coming. It's great to be here.
And we've known each other for a very long time, more than 20 years. And it's really a pleasure to be sitting across from you and hearing about your new role, relatively new role at BNY, what you've been up to, in addition to what you're thinking about the markets. So congratulations on all your success. We wish you nothing but future success with this role.
No, I appreciate that.
But let's start with I don't want to start with all the way with the beginning. I'm not going to take you back to Lehigh, but we do have a couple of students who are sitting in our studio audience today. And one of the questions that I ask regularly is, how did you end up in manager research and due diligence? We try to track students into asset management, but they're all pre-programmed to be investment bankers.
Bankers still, huh? To this day, it's incredible.
I can't shake it.
That's great. I love it. Great experience at Lehigh. It was amazing, even though you didn't want to go there. Finance, applied math, loved finance and just loved the numbers aspect of it. but I didn't know exactly what part of finance, like a lot of kids who were coming out of school, what area I wanted to focus on. So I was looking at primarily rotational programs at the time, and I looked on Wall Street and got into a few of them on Wall Street, but was enamored by the CFO at the time and the CEO and what SEI Investments was doing. It was so entrepreneurial. It felt like a younger company, a company where I can actually make a difference. And as someone young, I was naive enough to think that. And that's how I got into manager research, frankly, just being part of that culture and being part of that organization. That was just really getting into, what was not even termed OCIO, but OCIO today that everyone knows about. So that was a great experience. And that's really how I got into manager research. It was basically falling into SEI Investments. As I got there, I started my work, believe it or not, as like a custody implementation person, because we were doing these rotations in different parts of SEI, and quickly found the investment team and the investment management unit, and was part of the international and emerging markets team there, and just kind of never left that space.
The culture at SEI is very unique. It has been for a very long time. Bullpen seating, high ceilings, the cords are hanging around just because everyone is sitting together. When you think about the culture that you started with, how has that stayed with you over the course of your career? And
they also gave to relatively young professionals a lot of responsibility, which at the time I kind of scratched my head later on thinking, I can't believe they let me do that. Like I was flying all over the world at like 20 something and interviewing money managers in South Africa, Taiwan, Singapore, everywhere around, all over the place. I do try to keep this idea around, allowing people who are younger, newer, fresh ideas, like give them the space to speak up and give them the ability to actually contribute in a big way. And that actually creates an awesome dynamic in an investment organization. I always say that one of the things that makes a great research analyst is just curiosity, just lifting up every stone and understanding what's going on in an organization. And if you're not able to give people sort of that accountability and ownership, you're going to lose something with the younger folks with fresh sets of eyes.
I can testify to that approach. I have a story you might remember. Back when I was on the other side of this business and not doing podcasts and a professor, I had come to Northern Trust. I came with a money manager. We were in the later stages of the due diligence process. And this portfolio manager was convinced that they needed to meet the CIO in order to make the decision. And I was adamant, trust me, the team that this person overseas is responsible. He's given them the room to run, but this PM just wouldn't buy it. So I told one of your colleagues, I said, I'm so sorry, but this PM really wants to meet Chris Vella. Is it okay? And, he rolled his eyes and begrudgingly left the conference room and went and got you. And you came in and they were both sitting there and you stood up and he stood up and you shook hands very politely. And you said to him with absolute confidence that this person who's sitting there as part of my team is the decision maker and you don't need to meet me. I appreciate you asking for me, but trust me, you're in great hands. And that was it. And I saw you shake his hand again. You turned around and left, and the meeting went on. And I appreciated that because I think that's a part of the business that a lot of portfolio managers and GPs don't necessarily understand how much responsibility is sometimes given to those junior and mid-level analysts who are responsible for manager research. In addition to the culture that you adopted, inherited from SEI, what is it about that approach that you think is so important?
The folks who have a lot of gray in their hair, on their head, may not be as in tune with the most recent technologies and what's going on. And I think you can, my entire 30 years, I think you can say that. Like you say that there's always going to be new technology out there. And I think that someone who is younger and more curious, it just like really wants to succeed and use all the tools at their disposal, those are the ones who are really going to dig in and drill into understanding what's going on in the portfolio itself. How are the trades really being made? Who's making money? Where's the alpha being driven from? And I think that, again, I think that's where it's nice to have someone who has seen a lot of the tragedies in our business and issues in our business, because you learn a ton from that. I mean, the more scars you have, the better you are in terms of understanding strategies that'll do well in different environments and probably not buying it as quickly as someone who's younger. But the analysts who are on our team, their ability to implement using AI, their ability to implement different technologies into the portfolio that are sort of like, top notch, it's pretty impressive what they can do.
You went from SCI to Goldman, and Goldman is relatively more rigid. I'm a Goldman alumni as well, so titles matter at Goldman. So, but you were still given some pretty big responsibilities. You were actually building something within the ecosystem of Goldman. So very much an entrepreneur. What have you taken with you as you've moved forward in terms of that entrepreneurial experience?
Yeah. So Goldman, awesome experience there. 5 years there, and it was the opportunity to they basically brought in people from industry, brought in people who've had several years of experience in this space, but also had a whiteboard, like a blank sheet of paper, in terms of building a philosophy and a process almost from scratch on the traditional side. They already had stuff on the alt side for many years before, but on the traditional side, they really didn't have. They basically, it was mostly proprietary, and that was it. And they needed an open architecture to be competitive in the marketplace. Mm-hmm. And so that was our opportunity to say, okay, let's see what we can build here. And you're a Goldman alum. You don't half-ass it at Goldman, so it's. I don't know if you edit that out or not, but
it's fine. I don't think the FCC is going to catch that one.
I think we're good. But so in any case, it was like very thorough. It was very detailed. And at the same time, there was some latitude, and for an organization that is as rigid as a Goldman, there was a lot of opportunity for us with eyes of MDs and senior MDs watching over what we were doing, this ability to kind of build something almost from scratch. So that was a lot of fun. It was great. I will say the other part of Goldman that I kind of took away, like you go through each of these experiences throughout your career and you look back and you see what you pick up along the way. Very performance oriented. Like outcomes really do matter, and just watching strategies and investment strategies, and I always think of it as a consultant mentality around what you're doing day in and day out, picking and selecting strategy managers, versus a truly an asset management approach where ultimately the outcome for your clients is extremely important, and I think that the sort of that lens on performance was something that we spent a lot of time at Goldman kind of perfecting, if you will.
Yeah, that makes sense. Well, you were with Northern Trust for a lot of quarters.
Yes.
You were there for a long time. When you think about your history and you think about the experiences that you picked up at Northern, what was the hardest part about leaving?
The people, the friends. I mean, it was, my work colleagues were some of my best friends. I mean, that was very difficult to move away from the team itself. No doubt about it. Shout out to the Northern team.
I'm sure they're listening.
Exactly. But that was difficult. And I think that you build up your own kind of within an organization, your own reputation and what you're able to provide and what you're responsible for. And that's meaningful. And to completely step away from that after 20 years of building that in senior roles, that's also pretty tough to walk away from.
I'm always curious what that recruitment process looks like. So you're at the CIO level. You are a 20-year veteran of one organization that's built and grown substantially over your time there. Does the call come into you? What does that call sound like? What makes you take it?
Yeah.
And how did you think about the opportunity relative to what you just said, that you'd built up this track record with not just the GPs, but your colleagues?
Yeah. It takes a long time. It's not something that happens over a few weeks, right? It was months of discussions with senior people at BNY, and it has to hit a few checks, right? You've got to hit several boxes in order to really make a move like that. The boxes that were checked off, like the senior executive changes that the significant changes, and we'll talk about at BNY that were taking place, super exciting, like really like transformational, truly transformational. And I thought being part of an organization that's at the beginning stages of going through that was a great opportunity. And then there were small parts of the business that I touched at Northern, but wasn't fully ingrained in. And model portfolio management. It's one of the most important things we're doing right now within my team. And we did that at Northern Trust, but it wasn't a clear focus. It wasn't a big expanding business. For us at BNY, it's mission critical in my mind, and it's just a huge opportunity again within the RIA broker dealer space and helping clients.
What did those first 6 months look like? So when you think about that whiteboard, I mean, I remember when I first started at Goldman, I created a yearbook of all the people because there's so many people. So I know you're having to meet all of these different people, all of these different divisions, all of these different facets of the business. So once you have a good feel of the people, what did that whiteboard look like in terms of prioritization?
Entering BNY, it was a lot of those 30-minute calls. I've never had so many 30-minute calls with so many people for an extended period of time.
Is 30 minutes enough?
No, but it's always 30 minutes, right? It's definitely not enough. But so you're right though. You meet so many different people from so many different areas, which is fantastic, and it's a big organization. It's much bigger than Northern Trust in different businesses and leading in different parts of the markets as well, which is exciting. That whiteboard, I barely had enough time to figure that out, and we kind of shifted around. We took an opportunity to bring a few teams together. So I joined the wealth management group as part of Investor Solutions, and we kind of took a step back and brought 3 teams together into the investment management division. Ultimately, a year later, wealth and investments came together under Jose Minaya. But at the time, it was taking a team out of Pershing LOB, which was the old Lockwood TAMP. They came into our group. We took a global macroeconomic team out of London that was in actually our sales group, brought them into our team, and then expanded our group as well, brought in the private markets as part of our group. So we actually were able to kind of reorganize everything into almost what I always dreamed of having, frankly, like under one roof, to be able to have, strong rowers under one roof going in one direction. Like that's super powerful. So we had, from a client perspective, the OCIO team, and we also had a models portfolio management team leveraging kind of our centers of excellence. We had an asset allocation group that did everything from capital market assumptions, strategic and tactical asset allocation. We had a manager research team on the traditional side that covered 800 strategies plus, almost 900 today. A private markets team, so private equity strategies, fund of funds that we're on fund 14 at this point, so 2 decades of private market manager research as well within our group. And we also had a systematic team, like kind of a systematic equity fixed income, actually a GTAA group, which is again another great tool in the toolkit to help with asset allocation, having a factor analytics on that side, and also producing products with options overlays and things that are kind of unique for private wealth clients. So, a really powerful investment team, the 80 strong that you had mentioned, and covering just about everything you need at your disposal to help clients out. And that's how I describe the group is an extension of the investment staff for all of our clients. And it's such a great way to describe a team that you work for, right? It's like we exist to help our clients no matter what. Like, if you want support on the asset allocation side, you can just hire us on capital market assumptions, asset allocation. If you need support on manager research, we've got that vertical all set up. Private markets, same thing. Or you can take the whole thing. So we're basically able to support clients in lots of different ways.
It makes a lot of sense. We're going to talk a little bit about the teams in a second. It never ceases to amaze me when I hear 2 decades of private markets exposure at a firm like BNY at a time when in the media, it sounds like it was all just introduced in the last 6 to 12 months because of the democratization of privates and retail portfolios. And I know you have a lot of opinions on this, but when you think about what you inherited in terms of that 20 years of experience relative to what you knew you had to develop over time in order to meet the needs of a new client base, How did you balance that? Yeah. What you inherited versus what you knew needed to be implemented?
Very hot topic.
Yeah. I'm gonna get the clock going.
It's all good. No. This is work in progress. I mean, really, it's work in progress. So the team is a phenomenal group, right? These guys, the team itself has been involved in entirely on the fund strategy side, private equity fund of funds. And they've also been responsible for the platform of direct exposure across private credit, real assets, everything else, hedge funds for our BNY wealth management. It's been primarily BNY Wealth that this team really supported. We are going through our own transformation at this stage to really, to your point, to build that out significantly. So we are now looking at public-private partnerships to incorporate interval strategies, interval funds in everything that you read about, whether it's private credit, private equity, multi-asset, real assets like infrastructure. I really do feel like there's a place for these. Right now, it's interesting. It's a different topic. Like lots of people have different opinions on it. They always have. But if you are looking to give more exposure to private wealth investors, to a more resilient portfolio, to a better portfolio, I think it's a great opportunity for this product development cycle that we're in, and I think that there will be issues. We're living through them now in the private credit space specifically, and it's going to take a lot of education for people to understand exactly what they're buying into. But you're accessing a group of clients who never had the ability to invest in something that had a K-1. They have to have a 1099. Our ability right now, we're very focused on, as are many others in the industry, how do we incorporate these strategies into model portfolios? To go back to models. And the only way to really do that is to have a daily NAV, to have an interval fund, to have something that's priced on a regular basis as money flows in and out. So I think that this is, we're in the beginning stages of sort of some difficult times in terms of partially on education, like making sure that people really understand what they're buying and the liquidity profile of what they're buying. But at the end of the day, I think that this is going to hit, I don't think it'll be completely mass market, but if we hit the 401k space and other areas, it will be mass market. Everyone will have some exposure to it.
Dakota Recommends is your source for the highest quality coffee shops, restaurants, hotels, and event spaces in every major city where business happens. Dakota Recommends is thoughtfully curated by our team who has been traveling and hosting events in the investment industry for over 25 years. Log in to Dakota Marketplace today to see how Dakota Recommends can help you make your next trip better.
How much of that time right now is education?
Oh, it's a lot. It is a lot. It has to be.
What does that look like from a practical perspective? When you're thinking about, are you educating the advisors? Are you educating the staff? Are you educating the clients? What does the delivery mechanism look like?
So most of our time is spent with home office and advisors, right? So but we need to supply the front lines of the advisors with whatever they can provide to their own clients. Like if you don't provide that, they're going to be, things could be missold. And so it's important that we're able to pull together these educational pieces that are mostly home office, so they understand what's going on within portfolios and how to structure it appropriately, but also for financial advisors directly, and then arm financial advisors to really be able to talk to their clients about what they're investing in.
Does BNY advisors, are you still using the framework, the robust strategic asset allocation framework?
So we're actually, a lot of work's been done over the last 6 months to focus on more of a Black Litterman model than kind of a robust strategic asset allocation framework.
Going back to Goldman
days.
I know. I get it.
I remember Bob Litterman quite well.
I do too. And I remember that team quite well.
I was quite lucky to work pretty closely with him, actually. It was pretty amazing.
It's interesting that you're going back to Black Litterman. And I'm thinking about the menu. So there's a couple ways, we hear about it here on the show. And of course that you've been exposed to in your own career. There's the prefix menu, and you've talked about that with model delivery. And then there's a la carte. But either way, you have to have a table. So talk to us about that first step, that setting the table. What does that asset allocation process look like? And how is the direction of the meal set? Which way are we going? Are we going Italian? Are we going French?
Sure. Working closely with the client is really most important. I'll give you the high level process overview in terms of what we're thinking, how we're working with all of our clients. But then specifically, when you really drill down into a client's end portfolio, it's goals, objectives, client needs, demands. Like there are going to be restrictions that some clients place on you and all the rest of that fun stuff. But when you think about from a high level on the asset allocation side, everything starts with the capital market assumptions. It's kind of our foundation. We do it once a year. We've been doing that for, again, almost a couple decades now. So we have a real track record on setting capital market assumptions. So across 50 plus asset classes that we cover today, multiple currencies, that lays a true foundation. Then you have a strategic asset allocation on top of that, which is more of the Black Litterman approach. And then we have a tactical asset allocation team as well. So we'll be able to tactically shift portfolios around given the current market environment. Not every client wants tactical asset allocation built on top of what they're buying, if you will. A lot of our institutional clients are sticking with strategic asset allocation, and they're perfectly comfortable with that. They don't want to move around the portfolio as actively. Most of our private wealth clients, high net worth clients, and including our model portfolios, will be taking the tactical asset allocation advice. We've put together at BNY a global investment council that is across the entire organization. So, we've got Vince Reinhardt, who's like an expert in the Fed and in Fed decisions. The guy's incredible, works for our Dreyfus organization. He sits on this council. Jason Granite, who's our BNY CIO of the balance sheet. The guy's, he, again, fixed income specialist, is off the charts brilliant. So I think we've got a number of, we tap into all the different organizations, experts, and it's about 12 of us on this committee that gets together on a monthly basis. We get together quarterly in person and discussing the world, very tight agenda. It's about half a day to basically with an outcome of where do we want to move the portfolio around to. And each team ultimately will move the portfolio in their own way. So our fixed income team may do something completely different, if you will. But at the end of the day, there's a firm-wide knowledge around what are we seeing, where are the opportunities, where are the risks inherent in the portfolio, what do we think about rates that are going to be a key driver of returns over time. So that's a really critical part of that TAA. So then you've got your asset allocation set up. And you're thinking about how do you implement, do you want Mexican, do you want Italian?
Exactly.
Yeah. So that's the fun part, right?
It is. And that's where, and you've been doing that for 30 years.
Yes.
So
yes.
I know you've done all of the asset allocation work as well.
Yeah.
But when I think about you and your experience, you're one of the few people who have been doing manager research and due diligence
for too long,
entirely too long.
I just left a few of the senior manager research folks just before I got here, spent some time with them.
What were they saying?
They also have been doing it for too long. Like there's a senior group that's been that's probably more skeptical, which is a good research analyst, right? But highly skeptical about what's going on in the world. We want to make sure that we've got the right options available to portfolio managers and our clients ultimately, whether that's the financial advisor when we think about developing a platform for an organization, or it's our wealth management advisor within BNY when we think about their platform. We need to make sure that we have a good list of managers and options available, and best in class, and that's not that easy to do.
How do you prioritize all those managers? You talked about between 800 and 900 managers. That's a big menu. So we're getting back to the food. That's a heavy duty Chinese menu. You can basically eat anything you want. Yeah. But how do you know what's good?
Out of that, there's 147 that are high conviction list strategies. Which is still a big number, but there are designations around high conviction strategies, versus, and everything's rated. So we have above average, average, below average ratings across the board. There are 7 categories of factors that we're looking at and like 52 subcategories that we're evaluating for everything. So it's very, I mean, that's what I always tell my team, the most successful money managers in the world are the ones who are the most disciplined, the ones who do what they do day in, day out, and they don't stray from their discipline. And you want to bring that into your own investment process to ensure that you're consistent and you're disciplined, whether you're looking at a US large cap growth manager, a micro cap manager, private markets manager. So we've got the same team kind of working on all these different areas, and getting together is another key, I think a key difference between potentially some other places. We still have a relatively, it's 20 investment professionals, relatively, small team for that many managers. And they're all getting together to talk about each of the challenges that they're seeing or, opportunities and new managers they're hiring. So a fixed income analyst is sitting right next to the equity analyst who's making a recommendation for a new strategy. You're not using all 900, by any stretch anywhere. But as your business grows, you're just about 200 billion now in assets. We're working with clients all over the world with different needs. Unfortunately, that list does expand and grow out. And so I think that's something you were always trying to balance, even with the research team, in terms of coverage and oversight to manage their own time.
In addition to discipline, if I were to ask you to leave the room and I had your manager research team here with me, and I asked them, what other characteristics do you know that Chris likes to see before he gets introduced to that manager? What do you think they're going to say?
Consistency of performance.
Yeah.
I would hope that they would bring up consistency across the board. It's such an important factor for asset managers to be in an environment or an organization that's stable, to be able to run their portfolio in a disciplined fashion, but consistent execution. It's not so much that they have, no manager is going to outperform every single quarter, right? It's Madoff and they go to jail. You're looking for strategies that you could set your watch to. Like, that's the key. Like, you really want to be able to say, okay, in this market environment, this strategy is going to look terrible. And that's the time you should be adding more to the strategy, or you should make sure that you're rebalancing. Like, you are always a very strong advocate around having multiple strategies with unique disciplines that have low correlation of alpha within a similar area of the market. It could be value and growth in the large cap if you don't want to be too overly diversified, but it could be a yield strategy and a relative value strategy on the value side of the equation. And the goal where you're making money there is when one is totally out of favor and the other is doing great, and you're reallocating money from the one that's doing great into the one that's not doing so great, and then keep that balance.
When I interview folks, this is going to be the 5th year now. It usually starts with people. Well, we look at people first and we try to understand who they are as people. We think about, we had an interview earlier today, emotional intelligence. We try to understand cognitive diversity, all of these things, but it's really hard. For me as a professor, it's almost impossible to teach, but as someone who's interviewing, you at least have the pattern recognition. But the interesting thing about this industry is that there's no uniform personality. We get all different types, right? We get the person who never, went to college. We get the person who was a surgeon and decides to go back and do finance. You get all these different types, and it's really interesting. How do you ascertain whether the person is going to be the right partner for a BNY?
My first boss in the investment world at SEI, he basically described it as, I'm looking for great investigative reporters. So it was almost like, it's almost getting under the hood, getting into the mind of people at times, like getting inside their brain, which is, as you point out, very, very difficult to do. I don't think there's one type of characteristic or person that BNY needs to see in order to invest with them. I think if you go down that path, you're going to have a lot of strategies that are very similar. And that's a really dangerous road to take as well. So I think diversity around how people go about solving for this, very difficult problem of gaining alpha over a benchmark, which is not an easy task, but cutting that in different ways adds a lot of value for the total portfolio.
What questions in your career have yielded the most results?
Yeah.
When you're in those meetings, and it's not the first meeting, it's not the last meeting.
Yeah.
That middle is really hard, right? Middle everything is kind of tough. Middle management's tough. Middle innings are tough.
Yeah.
And those middle meetings, I presume, can be pretty tough.
Yeah.
What questions yield the most results?
It's so interesting, the psychology between watching like different research analysts work these sessions, if you will, these interviews differently is also really
Different types of reporters.
different types of reporters. Very interesting. I found a lot of times the open-end questions, like the questions that just like, let them go. And I think that the cream of the crop are the managers who really understand, like who know, like you fourth quarter of like 2017, we just like blew up this strategy. Like, what happened? And a lot of folks just will flounder around some of those. And the ones who really stand out are like sharp as a tack. They just get it. They drill on it. And it's like, yeah, that left a mark. And here's how here's what happened. And here's why. And here's how we might have changed something going forward. Like that's some of those things you're looking for. So we think and that's not an open-ended question, right? That's very specific. So I think you need a few of those, and you need a few to just let them talk and like, let's see where they go. Let's see the direction that they're going in to really understand sort of how they're thinking about this. We've been through enough crises where like just talking about any one of the multiple crises will actually bring some interesting discussions around how people react, didn't react within their portfolios.
Is the process effectively the same? So once the 147 managers have been named, as we all know, not all 147 are going to succeed. How much time do you give? That's something that we don't talk about a lot. This isn't you're not a public pension fund, so you don't have a watch list per se.
Right.
But but there's the watch list mentality that starts to take effect.
Oh yeah.
And that then changes.
We do have watch lists.
Yeah, good. That's interesting to hear, because I think there's something to talk about behavioral psychology. There's something interesting about being put on a watch list, not from a GP's perspective, which is I have to tell a portfolio manager that we've been watch listed.
Yeah, right.
Something can change, right? More risk, less risk, more securities, less securities, wrong analyst, right analyst. It creates a lot of movement for better or worse. Not always, but sometimes.
Yeah.
When the movement starts, how do you lock into what's part of what we expected versus, wow, this isn't what we bought?
I've always been a strong proponent of pushing the team to think about when we're going to fire the manager before we hire them. Is it a star PM? Is it a drift in a certain style? Like we should be thinking about terminating the relationship, because all you tend to think about when you're hiring somebody is all the good stuff. Everything's roses. It's all fantastic, but we should be pushing ourselves to say, okay, let's think about what happens when you terminate. And so I think that helps create a roadmap or a bit of a roadmap. And then you get into it. Something is happening. Performance is not there. And 90% of the time when performance isn't there, something else happened, that you just maybe didn't recognize, or the market's just way out of sync, right? And those are the things you need to think about. And that's where, we should, I again, a proponent of placing a manager on a watch list, even if there's no change to the people, the process, but performance is slipping big time. Because I feel like that just creates an environment and our own little ecosystem where we're drilling deeper. Managers should know they're on watch by the actions that their investors are taking. So if we're calling you every other week and asking you a lot of questions, you're on watch.
Is that Chris again?
I don't have to tell you you're on watch. You're on watch.
Yeah.
So, but we're trying, and so then to answer your question, how long do you stay on watch? That's always, easy to put a manager on watch, but it's hard to say, okay, you know what, they've improved X, Y, Z. And that's, again, place someone on watch, place a manager on watch, you lay out in a watch memo, what's it going to take to get off watch? And that's your, again, it's your roadmap. That's your guidepost. And managers should be able to go on and off watch, without causing chaos and anything else. Just because, something has changed, people might have left, new people have come in, you gain a rapport with them, and you understand what they're doing, all that stuff. The final termination, though, I mean, that's going to be, those are tough. And, there should be, you've got a track record of assessment and potential failure or not meeting the standards. And there are probably others out there where there's an opportunity cost that are doing a lot better.
Unfortunately, it's always the last question, I think, from an allocator's perspective is the operations. So when you think about the operational due diligence, so I'm going to ask it two ways. One is how small of a manager does the BNY platform look at? Are they looking at emerging managers, and are they thinking about that small of a scale? And I know that may be challenging, but I'd love to hear your thoughts there. And it's in the context of the operational infrastructure. So, where are accommodations made for the smaller manager? Or, do we need to ensure that we've got those boxes checked before we get through the operational side of a due diligence?
Unlike the days at Northern, where there was a business around emerging managers, or more of one at the time years ago, less so at BNY. I like creating a culture where that's very acceptable. It's tough. There's a higher hurdle, but I think you're missing out on something if you really completely avoid a strategy until they hit X billion in assets. You've probably missed out on a lot of really strong alpha on the way. So we do not have a minimum in terms of you have to be more than X to get a look. If it's hard, it's more difficult to invest in these strategies though. So just to be completely frank, so that's part of it. And I think there's the ODD side, the operational compliance side, has come a long way with outsourcing for asset managers to outsource their operations and compliance in a good way in order to make it through a strong ODD process. So I don't think you really need to give too much in certain areas. The one that you have to really keep an eye on and understand how it's structured at the firm is someone who's wearing a lot of hats. And they have to wear the right hats. They can wear more than one hat, but they have to wear the right hats. So your compliance officer can't be your portfolio manager and things like that. So it does take more manpower. And then it gets back to transparency. Like we will say, you're not set up or ready yet because of this. This isn't quite meeting industry standard yet. And there are so many outsource opportunities for money managers to kind of go down the path of. We spend a lot of time on ODD within private markets. And which is super important, obviously. There's less transparency in general around a lot of what you can find out about some of the private market managers. But we do invest in year one funds. Yeah, we do, and have had a lot of success doing that. So it's not everything, but it's a small percentage of funds of the total portfolio, and the compliance and ODD side is right there. Doing the evaluation of those strategies, and the team's done a great job.
For years, legacy data providers have made private fund performance benchmarking complex and expensive. That's why we launched Dakota Performance and Benchmarks, the first ever benchmarking platform built by people who are using the data themselves every single day. We've made our benchmarking affordable, customizable, and very, very easy to use. You can log in to Dakota Marketplace today to start creating your own benchmarks and viewing our created benchmarks, or you can learn more and book a demo at our website at dakota.com.
I'm going to spare you of the active versus passive debate in this conversation, but talk to me a little bit of active ETFs because they've grown so quickly. Nearly half of asset managers expect to convert mutual funds into ETF structures over the next 2 years,
and we're on that list.
Yeah. So where
as an organization,
I understand. Where do you see active ETFs being utilized? What's the house view?
I have been fascinated at a few years ago how many hurdles were thrown up there from peers in the industry. Say, I don't know, we're looking at it, but we're not really comfortable with it. How fast that's changed. That perspective has changed a lot. quickly. Our team has always looked at active ETFs. I mean, for years we have, and we've had exposure to active, not as many, granted, like not as many, but we have not shied away from it. So it's definitely like we've built the process around understanding liquidity and asset flows and capital markets around the ETFs transactions, like all of that. We have, most importantly, basically the expenses that can be built into the performance around some of these, and also the evaluation of differentiation between someone that has a mutual fund, an SMA, and an ETF. Is a differentiation between different strategies. So we've built that process. That's a muscle we have that we've had for years. So that's been great. I'm a strong proponent. The active ETF is meaningful in the RIA broker, in the private wealth space, and we're seeing that in the number of ETF model portfolios that are out there. The pickup of ETFs just across the board, as you pointed out. I mean, it's pretty incredible. So I think that trend will continue. I think that it's a really interesting space right now, and I would actually, because you and I are old enough, like I remember trying to push, like, why are you not doing a managed account? Like, why are you not, why are you not thinking about model research portfolios to help from a tax efficient perspective for some of these clients? And there are a lot of managers like, no way, not us. We're institutional. You don't hear that anymore. And it's, most people have gone into these businesses to really tackle. I mean, the growth in the private wealth space has been pretty tremendous.
Well, let's talk about private markets, just the last 5 minutes or so before we let you go. And you noted something which I thought was important, that advisors, they want to allocate more to alternatives, but there is more operational complexity. There is more paperwork. So how are you trying to lower those barriers to entry for your advisors and for your clients? Is it through platforms like AltsBridge?
BNY brings to the table tremendous infrastructure opportunities for their clients. Like, that's a big deal. So thank you for that. Your lead in, there's a little softball there. But I think that if we're able to master the single signature for some of these private market investments, it will be so much easier for advisors to avoid a lot of the operational back and forth and issues and swivel chair out of this environment into another environment to buy and sell private market investments. That's part of it. We also are, as I mentioned earlier, there's a strong push in the industry around creating unique wrappers and this product development around interval funds, and avoiding K1s, creating an environment for taxable investors of 1099s in the U.S., and lowering account minimums that you can put into these strategies. It's just the ease of, as you put it, the democratization, the ease of purchase for smaller clients is a real thing. And the more work that we've done on this, the more I actually think it strengthens a bit of the case of the 3C7 and the K1 and basically the drawdown strategies, because you will always have the drawdown perspective that will have a higher return because you have to have a liquidity bucket in the other areas. So as long as you are putting portfolios together where you know what that liquidity bucket allocation really is and you're accounting for that as you build portfolios, I think it makes a lot of sense for private wealth to still have those exposures. But you'll have folks who say, you're putting a drag on the portfolio of 20% in cash or some sort of liquidity element in that in order to save for potential redemptions. And I think that ultimately there'll be this 3C7 world, this drawdown world that will always exist for foundations, endowments, institutions that are looking for higher returns.
So did you time your start at BNY with ChatGPT and OpenAI coming to market AI? So when you think about your timing was interesting.
The movement of AI within the organization is
you basically started
incredible.
Right as soon as it was basically commercialized.
Close to it. Yeah. Complete luck.
So what was that like?
Like most of my career, total luck.
Yeah. Well, sometimes that's part of it. It's a big part of it.
Right place, right time.
Yeah.
So it has been great. I mean, it really is powerful. So from Robin, it starts at the top, and Robin is like pushing this very hard and has been from the beginning. It is such a strong initiative. All 50,000 employees will be trained on using AI. It is strongly encouraged not just to use AI at home, at work, but also at home. Like, use it everywhere. And at work, I mean, we've got multiple projects. We have 15 projects right now on the drawing board that will be implementing AI. We are right now wrapping up and initiating an AI research bot on the team. We've got an AI implementation in our ODD process as well to simplify that. We've got AI on report writing. I mean, so it's every division. And then every group within those divisions are really being pushed to, like, where can we use AI more and more effectively? Now, it's a closed environment. It's a 242-year-old bank founded by Alexander Hamilton. Like, so, and that is, people say that all the time. So you don't forget how important it is that the longevity of the organization is like palpable. Like, it's so important. And it's a conservative bank. But at the same time, the organization wouldn't be 242 years old if we were not thinking about, what's next, and innovation. And innovation is absolutely critical. And AI is like, that's all about innovation.
Are you applying that same open-mindedness to your asset management partners? So you have an asset manager who comes in and says, okay, we'll role play for a second. Chris, you're my manager research person at BNY. We are using it everywhere, anywhere. It's writing our reports. We've got an AI bot. From the top down of our organization, it's being implemented. What's the reverse of that?
So I don't know if there is much of a reverse. Honestly, like, I feel like I'm pushing the research team to ask more questions about AI and how is AI being implemented into asset managers' portfolios and the work that they do. I really feel like it's that important. I mean, look, for our group and the expectations I would have with an asset manager, human eyes are looking at everything, right? It's very important that we're checking anything that goes outside of BNY. To ensure that there are no issues and no concerns there. And I would imagine all of the managers are going to be doing very similar things at this stage. Like, there's no way around it. And I would also follow up with a lot of legal risk compliance questions too, because I know what the legal risk compliance world is within BNY. It's not easy. Like, the stuff I rattled off, you don't just do that on your desktop and you're like, oh, this is great. It's working awesome. No problem, Robin. It's like, no, not at all. It goes through a ton of checks and balances to ensure that everything is safe, up to stuff. And we've got AI expertise. That's the beauty of a big organization. The amount of money we're spending on AI, it's basically making sure that we've got people and resources to help us building this out.
It sounds like it's gotten you it's excited your career. The end, you're in this part of your career where you probably didn't think that maybe the next, 10 to 15 to 20 years are going to be in this wave of technology change. So it sounds like, from your answer,
it's exciting.
It's very motivating.
It is motivating. It's motivating. It's exciting. And it's, we're also in a position of where we're growing a lot. Which is a blessing, and at the same time, without technology, you're going to falter. Like, we cannot build at scale without some of these add-ons and enhancements, and frankly, AI to help support us. I mean, it just wouldn't happen, and we won't be hiring tons of people. And that's what I talked to the team about. It's like, people worried, oh, my job is going to go away. Well, I wouldn't view it that way. I mean, if you're not embracing the AI world, you're likely going to be set so far behind your peers in what you're doing that you're, someone else will do it for you.
Yeah, embrace the tools. This question probably sounds a little antiquated because of what's happened with AI the last 3 years. But when you think about the evolution of the CIO role, you've seen a lot of changes. You've been in this long enough. I know not as a CIO the whole time, but as an allocator the whole time. What does that evolution look like? And I hate to ask you this, but where is it going? Is it going to less people with better tools?
The environment and what's being built is getting more complicated and more complex day by day as well. So I don't feel like it's, the short answer is probably yes. I mean, 5 years from now, I would think the answer is going to be, if we're we're probably going to be at the same with a much larger base of clients and assets, or we'll be slightly less. We're not going to be like 2 or 3x the number of people. Like those days are behind us. So the future from that perspective is going to be, we'll be embracing some of this new technology to help scale what you have today and scale it in a way that we can customize. Like that's going to be the next big push. You can see customizing. You're already seeing it. The customization of models, the customization of portfolios for individual investors, and complicated strategies that are not that easy to describe to mom and pop. 130-30, like what is that? Like, this is probably round 2 of 130-30.
It is round 2.
This is a very successful.
It sounds like I'm calling.
It's a very successful round 2.
Yeah.
It's a little bit different this time too. Not that I hate saying those words. Those are dangerous words. Exactly.
This is being recorded.
Exactly. But the 30 on the short side and harvesting losses and building portfolios that are harvesting losses, like very purposeful short 30 to really come through with a portfolio that you're trying to unwind potentially significant capital gains in certain areas. It's really quite interesting what we're doing. And again, this is very complicated stuff. I mean, it's for us, it's not as complicated, but to describe it to the ultra high net worth even, or the high net worth world, it does get complicated. So again, back to this, what does the world look like? The advisory side of it's going to be super important. And that part doesn't go away in my mind.
All right, Mr. Vella. It's time for our lightning round. We're going to try to ask you some quick questions just to get a sense a little bit more of who you are, trying to get the depth of
but quickly.
But these are not deep questions, I promise. Okay. So are you an early bird or a night owl?
Early bird.
Early bird. Okay. What was the very first job you had? Very first job.
I worked at a phone company, answering calling people, annoying them on like a 1-800 number thing. It's horrible job.
Where was that?
High school in Westfield, New Jersey.
Okay.
Yeah.
What's a book you find yourself recommending over and over?
Oh boy, that's a tough one. I loved like the Ben Graham stuff.
Yeah.
I give that to my son when he wanted to be a finance major. Yeah.
From your time covering emerging markets, international markets, is there a country that you want to visit or go back to that you haven't been to in a while?
Such a great question. I've been lucky enough to go to lots of different places. I would love to go to all of them again, but I love China and Shanghai. It's one of my favorite cities.
What's an investing myth you wish would go away? It's something that people talk about enough, but it's something you kind of wish would die on the vine.
Tell researchers there's no such thing as a dead cat bounce.
Yeah.
Dead cat's a dead cat.
Cat's a dead cat. That's a good one. What's the most underrated trait in a great investment manager?
Curiosity.
Best piece of career advice you ever received?
Say yes.
What's a habit that keeps you grounded when markets get volatile?
Look, I think the most important things in life, faith, family, and what you do every day. You have to love it and have a passion for it. So
in one word, how would your team describe you?
Crazy.
In one word, how would your family describe you?
Crazy.
Okay. Consistency wins. Chris, thank you so much for being here.
It's great to be here.
It's great to see you. It's good to see you too. Thank you for making time to visit us in Philadelphia at Dakota Studios.
Hi, I'm Luke. I'm a rising junior here at Drexel University studying finance and international business. Thank you so much for your time today. I've had a great time listening to you guys' conversation. During your talk, you guys discussed a lot how new technologies like AI, the growth of private markets, and the CIO role continue to evolve in this market. With so much changing across the industry, I always found it interesting how great investors always seem to remain students of the market. So at this stage in your career, what are you most curious about still, and where do you intentionally like to invest your time to continue growing as an allocator?
What I'm interested in the markets overall, I think is an interesting question as well, because I feel like there are parts of the market that are becoming so highly correlated, and one area that I'm super focused on right now is finding areas that are just uncorrelated to the entire marketplace. For a while, I thought maybe commodities might play that role, and they're really not right now, which is kind of very interesting world that we're in right now. I think that crypto and other parts of the markets are going to be very interesting areas. But I think that the the unique strategies that are truly uncorrelated and truly differentiated from what's going on in the equity markets are going to be the most important moving forward. And in terms of just like digging into different like research things, like it's like going full in on something like a crypto topic, and just trying to get my hands on everything I can read on that. And that's actually that's one that is tokenization. 5 years from now, we're going to be most of the questions that Robert's going to ask me in 5 years will be around the tokenized funds and the trend around tokenized options for clients going forward.
Well, thank you for joining us for this extraordinary conversation. It was really a pleasure to sit down with Chris again. I've been very lucky to know him almost all of my career. So having a few extra minutes with him today has been wonderful for me, and we hope for you as well. If you'd like to learn more about Chris and BNY Advisors, please visit their website at bny.com. You can find this episode and past episodes on Spotify, Apple, or your favorite podcast platform. We're also on YouTube if you prefer to watch while you listen. And for more content, please visit our website at dakota.com. Chris, once again, thank you for being here.
Thank you.
And to our audience, thank you for investing your time with Dakota.
Don't say goodbye.